on the columns, the condition, the rows, that's the action. So let's assume that you're investing in Facebook, Apple, and the price falls below the limit. All right? The price falls below the limit, and the limit is this boundary. Then you may decide that you want to buy. All right? The action might be to buy, and you'll use a limit buy order. If your action decision is to sell, then you will have a stop loss order because you want to stop the loss. Okay? The price falls below a limit. Let's say you bought the stock at $60 and the price has fallen below 50 and the 50 was your limit, then you may want to sell. But let's say you want to buy more and the stock drops, then you'll have a limit buy order. The opposite is true. If you have price rises above the limit, you may opt to buy, if that's your action, a stop buy order. Right? So if you're in the process of buying, once it passes a certain price, you may think, well, that's too overvalued. You might not get a good capital gain on that purchase, so you may have a stop buy order. If the action is to sell, then you may have a limit sell order. Okay, so you want to limit the sales, so limit sell order. So understand this difference because it's an important distinction and it's one that you really have to jump on. So I'm not going to really spend much time here. You can go through this on your own. But this is just giving you a timeline of how the stock market has changed. It's sort of a historical demonstration of what has happened. Now, I would tell you that there's been some major changes. And for example, one of the biggest changes to date is now you could have fractional shares. Okay, you could actually invest. If you want to own Apple and you only have $10, you could invest $10. And you now have fractional shares, the ability to do that. So, here you can see in 2001 the minimum tick size became 1 cent. Okay, so a lot has really changed, and some important regulation came as well over this timeline. So if you're interested in looking at it a little bit more, you could spend some time in the book and read more intently. But if this is showing the market share of trading in the New York Stock Exchange listed shares, sorry, the diagram you could see represented here, where you could see how the market share of the New York Stock Exchange has dropped significantly. The market share in the early 2000s is over 80%. Now you could see that, through technology and through changes in regulation came significant changes with the whole distribution of market share when it comes to listed shares and trading overall. Different trading strategies that you should be a little familiar with. We have algorithmic trading. From the name, the use of a computer program to make a rapid trade. This is to facilitate high frequency trading. Again, using computer programs to make rapid trading decisions in order to compete for very small profits. Remember, there's some people that they do this every day. This is day trading to them, okay? So they're doing day trading, they're going through this process, and the minute profit is very important to them, even after transactional costs, right? Because they trade in major volumes and major capacity. We have a dark pools. That's another strategy, and this strategy uses ECNs, where the participants on the ECNs can buy or sell in large blocks, and they do so anonymously. So blocks have to be at least 10,000 shares in this dark pool. But it's an anonymous purchase, and it's a significant large block. And this is mostly institutional traders here, mostly institutional traders. And by being anonymous, this also has some really significant implications for the individual investor. So it's a very interesting strategy that the dark pools is a very interesting trading strategy. Now, this is a very old chart, and you should realize by now that your textbook is a little outdated. There haven't really been a new edition, but some of the charts definitely needs to be updated. I wanted to give you a chart from the book, so you could see here though that the market capitalization of major world markets. The main takeaway here is this: the size of the U.S. market is very significant. Right, this is $14,000 billion in 2011, and that has gone up significantly over the past 4 years. So the trading volume is very, very, very large in the United States. That's why we have a lot of international investors that invest in our markets here. So the market capitalization, the big takeaway is that the U.S. stock market capitalization versus the rest of the world is extremely, extremely significant. But we're moving towards an automated electronic trading system. Remember earlier I said technology has really changed trends in the investments and investing markets and securities markets. It's going to be a 24-hour world. You know, you'll be up and you'll be trading in some of in European markets, in Asian markets, if that's your thing. Some companies like TD Ameritrade facilitate after market hours trading here in the United States. The stock market closes at 4 o'clock. Well, some of these platforms allows you to trade after the stock market has closed. So we're moving towards more market consolidation rather than decentralization. There's more of a consolidated market, and technology has a significant amount of significantly behind this new trends that we are seeing. Now, there's a lot of cost involved when it comes to trading, and sometimes I think a lot of people ignore these costs and they do it to their detriment, and especially when it comes to some active traders. So there's usually a commission, and a commission, just like in insurance or just like in retail, is a fee paid to whoever made that transaction possible or whoever facilitated the sale. There's the spread, and that's the cost of trading with a dealer. Remember the bid price and the ask price? Well, the difference between the ask and the bid price, remember the ask price is the price at which the dealer will sell to you, versus the bid price being the price at which they will buy from you. So if the dealer is willing to sell to you at $90, okay, and they're willing to buy from you at $89, then you'll have a spread of $1. Does that make sense? So there's sometimes when you could actually both have a spread as well as a commission. It just depends on where you bought it, which channel did you purchase the stock or the security from. You could have a combination. Now, buying on trading here is also something that is very real and active, okay? So buying on margin, and the margin describes the securities purchase not with your money, but with your broker's money. There might be a position you want to take, you don't have the money to fulfill that transaction, so you tend to go and have buy on margin. Okay? Now there's some requirements. Like everything else, there's requirements, there's regulation, and there's cost. The initial margin requirement, now here, the Federal Reserve on the Regulation T sets out what this initial margin requirement is. So the minimum set by the Fed is currently 50% for stocks. So the minimum percentage initial investor equity, 50% for stocks. So 1 minus the initial minimum margin requirement will give you the maximum percentage amount an investor can borrow. So if the minimum set by Federal Reserve is 50%, 1 minus 50% will give you a 50%, and that will be the maximum percentage an investor like me or you can actually borrow from our broker. So equity, when buying a margin, we have position value. minus borrowing, the amount that you borrow, plus any additional cash. Okay? So your position value, you bought it on margin, minus the amount that you borrowed, and any additional cash that you may have put in. Importantly, we have the maintenance margin requirement. Now, this is the minimum amount of equity can be before additional funds must be put into the account. So if the stock fluctuates, the stock is going to fluctuate, okay? So let's say there's a fluctuation downward, all right? And the person that your broker decides, look, you must have $10,000 in equity. That's the minimum. You must always have $10,000 in your position value. All right? So if you don't have that, then they may have you may be in violation of your maintenance margin requirement. So if that happens, there might be a margin call. And if you fall below this maintenance margin requirement, the broker might say to you, look, you just simply have to put up additional funds, or we will have to liquidate your position. In other words, we'll have to sell it. We'll have to sell it, and you will incur any losses and costs and additional costs, but we have to increase your position in your margin account. All right, you need to be at a minimum amount in equities. All right? If equity or your market value is less than or equal to your margin, your maintenance margin requirement, then the margin call occurs. All right? So if your equity or your market value or your position value is less than or equal to this, whatever this number, the MMR, remember that's determined by the broker, then the margin call is going to occur. They're going to call you up and say, you need to put more money in or we're going to liquidate. Okay? If the market value minus the borrowed amount, because remember you might borrow on margin, divided by the market value, right? So market value over borrowed amount divided by market value is less than or equal to the MMR. You solve for market value. A margin call will occur. So whatever this is, if it's less than the MMR again, then a margin call will occur. So market value equals borrowed over 1 minus MMR. So market value is equal to your borrowed amount divided by 1 over the maintenance margin requirement. Gets a little complicated, but you're going to get some examples of this as well. Here's one. So initial conditions. You have X Corp has a stock price of $70. There's an initial 50% margin. 50%. Okay? So you have to put up 50% of this stock. The maintenance margin, the ongoing minimum that you should have in equities, is 40%. Okay? There's 1,000 shares purchased. So simple math. 70 times 1,000, your stock initial position will be 70,000. Because your margin is 50%, you personally put in 35,000 and you borrowed $35,000 from your broker, totaling 70,000. So the stock price falls to $60 a share. All right, your stock price falls to $60 a share. So then your overall stock position is no longer worth 70,000. It's only worth 60,000. Now your borrowed amount still stays the same. Remember, you owe this. Because if you're looking at the split here. So who takes the loss is you as the investor. You as the investor takes this loss. Okay? So the borrowed amount is still 35,000, but the equity is $10,000 that you've lost. $10 because the price dropped by $10. So $10 times 1,000 shares, 10,000. You lost 25. You lost 10,000. So given your equity position, $25,000. So remember that the minimum or the margin, the maintenance margin requirement is 40%. So how do we calculate this? How do we calculate this? We take your equity position, so in this case the 25,000, over the total position value, divided by 25,000 here, divided by 60,000, we get a percentage of 41.67%. So if you want to calculate how far this price can fall before the broker says you need to pay up, you need to put in some more money and give you that call, then you use the initial 35,000 divided by 1 minus the MMR here being 0.4 or 40%. So the position in total cannot fall below, or the market value cannot fall below 58,333. You got that? Work through it again, and if you have any problems, you'll get some clarification. So, continuing with the example, we have here the same 1,000 shares. The stock price for the margin call is $58.33. So that would take your overall equity position, your contribution, to 23,333. That would equal to the 40%. To restore to your initial margin requirement, you would have to have at least a position of $29,167, half times that value. So you get the margin call. This is what you have to put in to get back to that initial margin requirement. Okay? And I apologize, I have a slight cold. I'm dealing with a sinus issue. But continuing, remember we bought at $70 per share, but remember there's a cost. Yes, there's a cost. You'll have to borrow at interest. It's a loan. The margin is a loan. So we're borrowing here at 7% APR interest, and if you're using the margin account. Okay? The APR is 365 days a year. So you buy at $70, assuming no margin, and you sell at 72 in 90 days. You have a 11%, 11.59. If you sell at $68, you have the loss, right? That's no margin. This is you. This is your return. Okay? If you use the margin, your cost is going to go up. You sell at the same 72, but at a cost of 16.17%. And then your overall, if you were to sell for $2 less than you initially paid, then you have 30% loss. And then you have different leverage factors. And here's another illustration of buying stocks on margin, similar to the one that we just went through a minute ago.